Hi there everybody, and welcome back to another stock analysis video. Today we are going to be analyzing the company Capital One. Now this is a bank, guys, and I didn't realize that they actually had earnings after close on Thursday, as you can see right here. So I figured we have done a lot of banks so far, so let's end it with another bank in Capital One. So let's analyze this using book value and tangible book value ratios to see if maybe at the current share price it is a really good buy. So with that said, let's get started with this analysis. Coming over here, guys, to the dividend summary. Company does actually pay a pretty good dividend at 2.12%, which ends up being 60 cents per share for an annual payout of $2.40. Now the payout ratio is actually really tiny, under 10% of 8.59%, which is actually really good. I personally like to buy anything under 60. Now the 5-year growth rate on this dividend is not looking too shabby either at 8.45%. However, what isn't looking good though is this dividend growth of one consecutive year. Now we actually have seen this trend before with other banks as well, but if we actually take a look at Capital One's, it's actually slightly different. Unlike the other banks where they essentially kept it the same at around the time when COVID hit, well, Capital One actually cut it, going from 40 cents to 10 cents on May 7, 2022, August 6, 2020, then keeping it at 10 cents again to November 5th of 2020, then bringing it back up to 40 cents the following year, bringing it up to 40 cents the following year on February 15, 2021, and then actually increasing it again that same year on August 5th to 60 cents, which is what it currently is at right now. But if we actually take a look at this even further on the 10-year, we can actually see that this company doesn't have a lot of dividend growth, right? From May 6, 2015 all the way up to May 7th, 2020, they kept their dividend the same at 40 cents per share, which is again fairly surprising because they didn't even grow it even though COVID wasn't a thing prior to 2020. So when it comes to this dividend, well, it's actually not as good as the other banks. However, let's see how their shares outstanding is doing, because maybe they were buying back shares during this time, therefore by proxy giving you guys a bigger piece of the company and having the exact same effect that a dividend would give. Now, ex-dividend date passed as of May 13th, payout date was May 27th, and they pay their dividends quarterly. Alright guys, we're over here at the calculator. We're doing the book value and tangible book value ratios because again, banks are best for this. Ticker symbol of COF, market cap of $45 billion, PE guys of 4.51. This is actually looking really good, and it's kind of in trend with the other banks that we have analyzed, really low PE. So with the current share price of $114, this might actually be a fairly decent price. We're going to take a look at the book value, of course, and tangible book value, and compare this price to that to see what is the actual ratio and whether or not we would like to buy this company at this current share price. Now, in regards to this dividend of $2.40, this ends up being $957.6 million being paid out in dividends every single year. Coming now to the fundamentals, guys, we got the net income 5 years ago of $2 billion to today, guys, of $11.5 billion, increase of 479%. And this is actually looking fairly surprising because you can see that from 5 years ago to 2 years ago, roughly, when COVID happened, essentially it went kind of nowhere, right? But then after COVID, boom, it just completely shot up, going from $2.7 billion to $12.4 billion. Massive jump. And even though, guys, this year it is not over yet when it comes to this company's fiscal year, I believe they end in December, but you can pretty much just estimate that they'll probably exceed their net income that they did last year this year, just by the fact that they're already at $11.5 billion. Now looking at the total revenue 5 years ago of $19.7 billion to today, guys, of almost $32 billion, increase of 62%. And we actually see something very similar that we just saw with the net income. 5 to 2 years ago, they went up until 3 years ago, then they came down 2 years ago, probably because of COVID, and then shot right back up, going from $18.26 billion to $32.4 billion in the span of 1 year, which again, probably because interest rates were very low, so a lot of people were taking on loans when it comes to cars, when it came to housing and all that stuff. So that's essentially why I believe their total revenue went up within the span of 1 year. Now let's actually take a look at the metric that tells us whether or not the company is diluting you as the investor. When we were analyzing the dividend, I said, you know what, I get that their dividend hasn't gone anywhere, but maybe they have been buying back shares within this time frame and thus giving you the exact same effect that a dividend would essentially give you, right? The more a company buys back shares, the bigger piece of ownership you have, right? So as you can see right here, when it comes to Capital One, they are doing a pretty decent job of this, right? 5 years ago of 485.5 million shares to today of almost 400 million shares. From the 5 year, this is a decrease of 17.82%, and from the previous year to the current year, this is another decrease of a whopping 3.6%. Now, what is fairly interesting, guys, is that from 3 years ago to 2 years ago, they actually increased a little bit of shares here. Again, probably because of COVID, they were like, you know what, we want to issue a couple shares here because we don't know if we're going to still be solvent by the end of this. We have no idea what's happening, right? So they actually went from 456.6 million shares to 459 million shares in that 1 year. But then afterwards, guys, look at this. From 2 years ago to 1 year ago, they went from 459 million shares to 413.9 million shares. Massive drop within the span of a year. Right then and there, that completely offset the increase from 3 years ago to 2 years ago. And speaking about insolvency, let's actually see the total assets minus the total liabilities. Essentially, guys, this tells us whether or not the company is able to survive an economic downturn, which right now it is a really hot topic, right, with 9.1% inflation. So let's take the company's total assets and subtract the total liabilities. And what I'm essentially looking for is, guys, of course, for starters, for it to be in the positive, and second of all, to be consistently growing. Now, it's actually fairly interesting right here. Currently, they're at $56.3 billion in this difference, and within the past 5 years, they have been increasing this as well. Now, you guys are saying, well, this is lower than 1 year ago. Well, understand that this year isn't over yet, so this actually might be slightly higher than the previous year once we end this year in December. Taking the average total assets, we get $402.8 billion. Average liabilities is $346.8 billion. And doing this difference, we get $56 billion. And now, guys, looking at the valuation, starting, of course, with the book value per share. Essentially, this tells us how much the total company is worth based on tangible and non-tangible assets, right? So this is actually available for everybody in Seeking Alpha, as well as I also believe Yahoo Finance. You just look at the balance sheet and you look at for the book value, and in some cases, Seeking Alpha also has book value per share, which they just take the book value and then divide that by the total common shares outstanding, and that's essentially how you get this metric. And currently, guys, this is pretty much just telling me that the company today should be worth at around $129.08, up from the prior 5 years of $91.39 of 41%. Now, while the book value is a great way to see a company's total equity, right? Well, a lot of people think that the tangible book value is an even better representation of the company's intrinsic value because it removes anything that is not tangible and only takes into account tangible assets. As you can see right here, currently, if we do the exact same analysis, we can see that the tangible book value per share today should be worth at around $91.78, up from the 5 years of $60.59, 51%. So now let's actually take these book values per share and do a price divided by this book value. And this ratio, guys, essentially tells us how overvalued the company is today. So doing this math, we can see that today, the current book value per share is at a ratio of 0.89, which essentially means that in accordance to their book value, the company is actually trading undervalued. Anything under 1, it is undervalued. Above 1, it is overvalued. Not 1, it is at value. If we actually take a look at the price divided by the current tangible book value per share, we can see that we are at 1.25, which is essentially saying that in regards to the tangible book value, we are slightly overpriced, right? Because of the fact that we are over 1 by 0.25 points. So in this case, guys, you have two metrics that one is saying that it's a buy, the other one is saying that it's not. I would say that the truth is actually between these two numbers, between $129 and $91.78. So at a price tag of $114, you might actually consider buying this based on the fact that these two metrics, which don't take any assumptions, is basically telling us that in one it is undervalued, but in the other one it is overvalued. Essentially, I think that maybe at around 114, 110, it might be a fairly decent price to buy it at. Now guys, this is just again my opinion. I'm just showing you guys the raw numbers, right? I'm consolidating everything that is available in Seeking Alpha, and then I'm bringing it here to you guys so that way you guys can see as to what to look for. That's why guys, I have this calculator, the book value one, as you can see right here, the discounted free cash flow one, a REIT one, and a dividend tracking sheet, all available for you guys to have, because I believe you guys should do your own due diligence, do your own research, based if the numbers that you are seeing on the company make sense, right? After you do this basic research, then you should go further in depth to see what the company does, what their projections are, what kind of plans, what goals they have, what is their company culture, etc, etc, etc. But only after these basic numbers make sense. That's just my investing strategy. Not saying that is correct, but it is a strategy that I like to promote. And again, none of this is financial advice, and every investment is the present value of all future cash flow. That's why, again, have this calculator for free, guys. It is in my calculators playlist. There is a link in the description. You go there, you make a copy, and you make your own assumptions when it comes to whether or not to buy the company. All I'm asking for in return, guys, for these free calculators, as well as a dividend tracking sheet and just overall free content, is just please help me grow my channel. That's pretty much all I'm asking for. You know, I'm giving you guys free content, and I'm just asking for something free in return. 5 seconds of your time. Just hit that like, hit that subscribe, and of course, tell your friends or family if they would like to learn how to invest using a fundamental process. Also, guys, because a lot of you guys have subscribed, I figured, you know what, I need to bring all of you the best kind of content I feasibly can. So I recently just bought a microphone that hopefully should get here on Friday. So, you know, I am trying to give you guys better quality content because of the fact that so many of you have subscribed, and I'm very, very grateful for it. Thank you all so much, and hopefully y'all enjoying this content. Now let's actually take a look at this dividend a little bit further because, well, as you can see right here, they do pay out a dividend, guys, as I said, of $2.40 annually. So let's just say that you make the average US income $68,703, right? Bringing this to the monthly, we get $5,725. If we actually put in 1 month's income into this company at this current share price, guys, this actually buys us 49.89 shares, and at the current annual dividends per share, this gets us $119.73. This gives us an annual dividend of $119.73, quarterly dividends of $29.93, and a monthly dividend of $9.98. So as it stands, guys, this is actually not too bad. However, I have analyzed again other banks that give a whole lot more when it comes to a dividend. I'm not naming any names, but definitely Citigroup, just saying. So all in all, when it comes to this, I'm not saying that this is bad, but there are companies out there that have better fundamentals and have better valuations as well. All in all, guys, this is a company that I honestly am kind of just indifferent about. Capital One is just one of those companies that, just looking at their fundamentals and their valuations, it doesn't scream anything to me. The one that did, though, was Citigroup, as I just mentioned, right? Because, again, it's just amazing how Citigroup was that undervalued for that long, and it still was, and it rallied to the point that I believe now is at around like $50 or so. And on top of that, guys, Warren Buffett actually dropped Wells Fargo for Citigroup as well. So Capital One is just one that's kind of meh in my personal opinion. It's good, it has its positive, but it's nothing to like go crazy about. That is just my personal opinion. But that pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my YouTube sites, link in the description below. So with that said, peace out, be on the lookout for the next stock analysis video.